Today on the Gray Report, an exclusive research report from Gray Capital detailing loan maturities, distress in the multifamily market. This is a brand new report from Gray Capital that the team has been working on, led by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital, also co-host and producer of the Gray Report. But today we're also going to be talking about reports from Urban Land Institute, Fannie Mae, Bloomberg, the Wall Street Journal, Apartment List, everything you need to know to keep you up to date, up to speed on what's going on in multifamily and commercial real estate. We're going to get into this explosive report that has been put together, really detailing and outlining what the next, call it 6 to 9 months may look like in the multifamily industry with a wave of loan maturities that are coming due in October. Dr. Matt Bosnagel, he's here to break it down, bring us into the details so we can make some really thoughtful investment decisions now and into the future. This is going to be a good episode. Stick around. Okay, let's get into it. All right, welcome back to the report. Matt, how are we doing?
Pretty well. I think my mic's not on, so I'll turn that on. I'm doing pretty well. This was a really exciting week, actually.
Yeah.
Getting this report out and getting a lot of things organized, and I think it's gotten a lot of attention. And
it's getting a lot of attention, Matt. We also did a YouTube live yesterday, kind of going over the report. You can check the video out on our YouTube channel, but we're going to talk about the report. What's the easiest way for folks to download the report so they can actually just go
GrayCapitalLLC.com/report.
So GrayCapitalLLC.com/report. You can download it's a free report. All right, Matt, I want to take a look at the report itself because it's really an impressive piece. I mean, this is a lot of research. This is a topic that we've been covering like every single week or just about every single week now for like a year now because I've gone back to like episodes about a year ago. So what's in the report? What are the big takeaways? And I also want to know, like, how is this put together? Are you doing the research? People want to know.
So we're collecting a lot of research from either publicly available sources or sources that we've, either pay for the service or we pay for the piece of information ourselves. So we're kind of actively just digging into whatever piece of data that we have, and we notice patterns. We do our analysis, and I think that we've pinpointed a very specific moment for the multifamily market later this year, and that's kind of the takeaway of this report is the when. We may not get into where it will happen, not in this report, but it certainly is great to know when to strike. And I think that this report does a good job. We go through the Federal Reserve projections. Yeah. We have information from Mortgage Bankers Association, from CoStar estimates, from information about CMBS loan maturities, and just the total amount of loans that are coming due, which is, depending on where you draw the line, between 1.5 or 1.9 trillion dollars. It's a lot.
2025. No, that's a lot. I've seen the 1.5 or one off the 2 trillion, even almost 3 trillion through I think 26.
Yeah.
But so Matt, there's a graph on the report, and we're going to let everyone know where exactly to get this in just a second. I guess GrayCapitalLLC.com/report.
Yeah.
But on this graph, what stood out to us, and we've been looking at this graph for a little while now, and I don't know if we shared it on a previous episode. Maybe I think we teased it, but is these 2 red lines that you've identified in October? That's October and November of this year. That's not that far away.
Yep.
And so this is loans that are coming due, loans on multifamily properties that are all going to be coming due at the same time, right? So there's like a balloon payment that these borrowers have that they have to give that money back to the bank. The loan is due. So they either have to sell it and return the money that way, or they have to take out another loan and refinance it. But the problem is there are so few transactions being done right now. There is pricing uncertainty in the market, so no one knows where prices are, and people know that prices are lower. And if you've bought a property recently, you don't necessarily want to sell it at a loss.
Yeah.
But then on the refinancing, to refinance it, they're having to bring, according to the report and our analysis, Matt, they're having to bring between 15 and 50% of the original equity from the project itself just to keep the deal and just to like roll the debt. which reduces returns in the future. And that's challenging because, as we've reported and is also reported in the report, Matt, that debt and equity are like as tight as like they've ever been. I mean, I think this is coming from NMHC's survey of apartment conditions, but but very well. I think the story is pretty clear here.
Yeah.
There's not that much. The liquidity just isn't there. We're looking at October and November of this year, Matt. What other takeaways are there in the report? Why should people download it?
So I think one of the most interesting things that we found was this relationship between the sales that happened. We're looking here right now at the sales volume between 2019 and 2023, and you can see a clear jump in basically Q4 of 2021. And if you follow that forward, that big jump is when the loan maturities are being due. And, it's a little bit of a fill in the blank, but it's also the blank that everyone's filling right now.
It's not too hard to understand and to make the jump. So all these loans were 24 months, so like 2 years, like bridge loans that were taken out at the end of 2021, which makes sense because if you think about it, it's really the story of COVID.
Yeah.
And that since deals didn't transact, so again, look at this chart, Matt. We had the first quarter of COVID. The first like month and a half of like 2020 was like kind of sort of normal. I mean, remember, it wasn't really till like March or so that like everything shut down and like no more deals. So that's the first quarter was relatively normal, and then it really kind of just dropped off into where there were very few deals. Where again, if you look back to 2019, Q2 has typically more deals than in Q1. But they dropped off, and no one was really doing deals. At the end of 2020, some people finally got in the market and did some deals. So there's a big jump here, really back to just historic levels of normal deal flow. We were buying deals right then. But it was in 2021 when the rent growth really started picking up, that whole story.
Yeah.
And the prices started getting crazy, and interest rates were now at zero. That people were looking to do deals and finally started closing those deals that they had been working on at the end of 2021.
Yeah.
Starting in October, rolling through November. And you see that in the fourth quarter, it's a huge spike. And so this is like the wave front. And so it's not surprising then, it's very easy math, 24 months later, 2 years later, quarter to quarter, Q4 of now.
You saw the spike then. And then there you go, right there.
And so here's the spike again on the other side of these loan maturities. And so what I'm have been like referring to this kind of period of, and you've really highlighted, Matt, this section really can all the way through 25, kind of October to October 23 to October of 25 is like, this is when there's a lot of maturities in general throughout this entire year.
Yeah.
But I think this period of, again, October, really kind of fourth quarter and just a brief part of Q1 of 24 is where we're going to have like the maximum pressure on the system.
From maybe even that specific situation. And one thing that I was thinking of is because there hasn't been a lot of deals, of deal volume anyways, then the few deals that do sell, they may set the market in a way that, all these people that aren't participating, they may regret.
Well, that's it again. So there's so little price discovery, right?
Yeah.
There's no one's really sure. There's a few deals being sold today, which there's relatively little maturities that are happening today. So there's like, there's a couple deals that need to be sold, but there's buyers.
Yeah.
But the question is if that shifts and there's, instead of having just like a trickle of deals on the market, there's like a flood of deals and they need to be sold, and there's not enough buyers at the time because about 50% of like market participants are just pencils down on the sidelines, and they're not going to get in at that time of like things look a little scary right now.
Yeah.
And so all of a sudden, those first prices that get sold at a big discount, there's gonna be blood in the water. I mean, people are already smelling the opportunity, and they're going to take full advantage of it.
And that's what it seems like now. And it's maybe only just from our perspective. And we wrote this with our, with a strong conclusion, I think that we're standing by, but it's hard not to see past this at some kind of opportunity. And I just know though, we'll get to see headlines about this as a very negative thing because it's going to mean that property values are going down.
Yeah, I think that, exactly. It's going to be scary at the time. And, it's like, I think and there is a floor, I think, on pricing.
Mhm.
I don't think prices are going to decline so much.
That's what it seems like.
Because there is a ton of money.
Mhm.
That the long-term fundamentals make a lot of sense, but that doesn't mean prices need to come down a little bit relative to where like interest rates are.
Yeah.
And so there's just not the premium on the risk in the market like today. And so that has to correct and that has to readjust. There's going to be a cyclical reset.
Mhm.
And in many ways, it would be much better for the market for kind of the bad deals to get flushed out of the system and prices to reset.
Yeah.
So the cycle can reset. The alternative of which, and we kind of in the report is laid out the kind of two possible scenarios that I guess we're kind of just laying out. We're not saying that either are absolutely going to be the case, but I think kind of just two different categories and different ways to look at it. And I think, Matt, you did a good job putting it. It's an uncontained wave of distress or contained distress. So you're saying there's going to be distress no matter what.
Yeah.
And maybe, in contained distress, it sounds like it's going to be more pocketed. And it's this idea that this rescue capital that's out there, all this dry powder, it is going to flood into the system and provide a floor, to a point where there's really not that many price declines, maybe a little bit, but not a full falling out. There's not going to be just material distress and panic. It's kind of going to be all right.
Yeah.
Like there's going to be some extreme cases.
It'll be bled out over a series of time.
But that gets drawn out.
Yeah.
That gets drawn out. And we're going to be wading through the muck of just a little bit of just like low returns, and the whole cycle's not going to really kind of reset itself.
Yeah.
And if it's not the rescue capital, it's going to be this idea of extend and pretend, which is what lenders are calling it, of basically burying our head in the sand and saying like, don't tell me about the evaluation. Don't tell me about the financials. Let's revisit it in a year. Interest rates will be lower, hopefully. And if they're not, well, we're back to you're screwed.
Yeah.
But like, I don't want to deal with it right now. And the real idea, it's not just to like, let's all just get along and hopefully there's no pain. The idea is, okay, well, if we're going to have the distress, can we just like spread it out and not have it all be in, October or November in Q4 of 23? Because, again, they like to take these big bars, these spikes, this period. If they can just spread it out over the next like 2 years, they can deal with it one at a time. There's going to be maybe less volatility, more certainty in the market. And because these are their clients, these are their source of business. They don't want to see them necessarily go out of business.
I wonder if slow sales volume makes that less attractive. If they can't sell it, why do you, if you don't see any kind of exit, if there's no way out, I don't know.
For the lender?
Yeah.
So I think that's what they're saying. Let's just keep it on the books. But what if they can't keep it on the books? That's the question of, what can the bank keep on their balance sheet if all these loans and the collateral is all of a sudden in question? And then there's the factors we haven't talked about today. And I talked about it a lot on the webinar, the YouTube live we did yesterday. You can check it out on the YouTube channel. A lot of these same banks and lenders are also the lenders on commercial properties. And if you look at the delinquencies,
that's a good point.
The delinquencies for office property, it's the same story, but like 10 times worse.
But it doesn't mean, it's not like we improve by comparison. It's that they're getting beat up on office loans, and now it makes it even worse.
Yeah, it's it's their commercial real estate bucket. If they're looking at commercial real estate portfolio, loans, CRE. It's multifamily, it's industrial, it's office, it's all of that.
Yeah.
And so multifamily, again, the fundamentals could not be more starkly different. And the distress that we're seeing, it is extremely different. Current loan delinquency in office is in like the 4% range, just on the 30-day delinquent. On the 60-day delinquency, it spiked in the last 2 months. It's up to 2% of all outstanding loans. So 4% of all outstanding office loans are 30 days delinquent of publicly available data. 2% is 60 days. That 60-day delinquency, that's a huge spike from just the last couple of months. So this is it started really trending the wrong direction in the last 2 months. So we're boiling towards that point.
What's the average? What's like the normal number?
For office, I'm not sure. I don't know.
Well, for like, but for multifamily,
So here's the difference in multifamily.
Yeah.
In multifamily, it's 0.4%.
Okay. All right. That is much different.
And then it actually dropped. It's actually the delinquency, loan payment delinquency has gone down recently to 0.2%. So like multifamily right now is actually, it looks really good and really stable. Because we haven't gotten to this period of where they're starting to reset and people are squeezing by. It's not like, it's not necessarily the case that like people are below break even. The cash flows are thin in some of these cases if they're on floating rate loans. Like they're thin. They're not typically, some are probably breaking even, but they can still pay the mortgage for the most part. Yeah. The problem is in the takeout and what their loan proceeds are now. When they go to a lender, we'll go back. When they originally went to the lender to take out these loans, interest rates were basically zero. And so you're just paying for like, there was typically a floor and then you're paying a spread. So, like say that they're starting to borrow at like 3.5% on these bridge loans or 3.75% was probably kind of in the range, but maybe some closer to 3. Okay. So, but basically nothing. They're buying at low cap rates. They're buying at a 4% cap rate, but at a 3.25% interest rate, okay, that I can make sense of that if I'm modeling in 15-20% of rent growth. So it seemed to make sense. Floating rate loans seem to be they're in vogue at the time because if you were a holder of a bunch of fixed rate loans that you could finance your property, all of a sudden those prepayment penalties had actually increased. And so you had all these people who had floating rate loans looking really smart because they're like, well, on the floating rate loans, the prepayments are actually gone down. Or it's only 1%. Yeah. And I've got all this flexibility. And look at all the money you're leaving on the table because you can't transact right now with your fixed rate loans.
So that makes it easy. So prepayment penalties means if you sell this, then you got to pay the bank a little.
Well, the bank's like, oh, it's a 10-year term and you're selling it early. And, we were counting on that income. And so we want to make sure we're at least going to get the income and the return that we thought on that loan. So we'd rather you hold to maturity, but if you want to sell early, it's fine. But there's a little bit of take it in different loans have different types of penalties, and some don't have a penalty. Yeah. But the penalty isn't necessarily the point. The point is just there's a drive to do these loans you get high leverage, 80-85% loan to value. Some with pref equity behind it, so very little equity. I mean, I'd see like equity, like 5-10%, like very little equity in these deals, high levered. And they were like, well, we'll either sell it in 2 years or refinance, and we're going to do big, cash out refis, or get all this rent growth, NOI growth, everything's going to be perfect. Now, a year and a half later, interest rates are no longer on that same type of loan. It's no longer 3.25 or so, or 3.5. It's like 6.5. Yeah. The loan to values are no longer, but for an agency, let's say that which probably makes sense for the takeout today, you're paying 5.5. Okay. Still significantly more. But your loan to value isn't 80. Your loan to value is 60. Yeah. Your valuation though, so then it's okay. So just like if your valuation stayed the same, if the valuation just stayed the same, you have to bring that spread. That 20-25%
so
spread.
$10 million. Let's say your loan to value, if everything's the same, $10 million.
Yeah, so you had to bring $4 million of equity.
And then you got to bring more money back, even if interest rates haven't changed, because the loan to value.
Sorry, so if you had an 85% LTV, you started with you'd have to have $1.5 million down payment.
One, that's just ingredient one.
Now you're going to have to bring an extra $2.5 million. Yeah. So more than double. Wow. Yeah. And that's more than even what were in our models.
Well, because.
But that's absolutely the case.
And then like, as you just insinuated, property values are down.
So that's the evaluation is the same. If the valuations have declined. So can NOI, while we've had rent growth, we've had expense growth. So NOIs are basically flat. The cap rates have gone up. Yeah, we're no longer in the 4.5 to 5. We're in call it 5 to 6 with a question mark on it. So now what we don't know is our appraisers, what are they going off of? Are they going off of 2022 and 2021 sales data with high prices? Yeah. If that's the case, maybe they'll appraise. But if they go out after some of the new data, or they know the market is, or they go off of like information from like public REITs, I think there's questions on where those values are. It's a big question, and different appraisers are going to honestly do what's in their interest to continue their business with their clients, to be honest. But there will be a point where, okay, the emperor hasn't closed. And this is whether it's an extend or pretend, or we're looking at these valuations of like, no, the asset is not necessarily worth more today than it was a year and a half ago. Maybe it's worth the same at best. A lot of people are saying it's about worth the same.
Yeah.
So you're going to have to bring so much money. You have to bring, again, in our models, kind of as a conservative estimate, 15 to 50. But as we've seen, it all depends on leverage.
Yeah.
If you levered up to that point, that you are 85, 90% levered, it could be double.
So
you have to go back to your investors.
So if you're talking about, if you have these, the interest rate's higher, then you've got to bring more money. Or is this all dependent on?
Well, it's because the interest rate is higher. It challenges your debt service coverage ratio.
Okay.
And so you can only borrow so much. They're not going to They're not going to let you borrow money that the cash from the property isn't going to be able to pay the mortgage and then some.
Yeah.
So you have to clear a certain hurdle. And so as your debt service payment goes up, it's harder to clear that hurdle. And debt service payments are double and triple. But if you were on a floating rate loan between a couple years ago and today.
Yeah. Wow. That's crazy. I mean, you look at this and it doesn't seem like pretending can get you out of it. If it's just like, there's so many mathematical things where.
I was talking to a new investor today, and he was having a conversation. They looked at a deal. They're like they're an RIA, registered investment advisor, and he was talking. They had looked at a deal with a sponsor they really like. This is a good operator, and they decided to pass on it. He's like, we're seeing a lot of skinny deals. We're just passing, and they have a similar view of the market that we do. And he's like, but we knew someone that did participate. It was like friends and family around. They participated in it, and he's like, this is about a year ago that they saw the deal, and he asked how it was going. And they had floating rate. Same situation we talked about.
Yeah.
He's like, the hole's so deep. He's like, I just don't know how they're going to get out of it.
Yeah.
Like it just seems so insurmountable at this point.
Yeah.
Like, and so that I think will be the difference. And I think maybe it's what giving some people some false hope is that they think that they're close. And I think if you're close, like, I think you will figure it out. It will be all right. But in some of these cases, like it's not close.
Yeah.
And you can't pretend. And that's what we don't know how much, like that's what we wanted to get is like, okay, and it's too hard because every market is different. Every deal is different.
Yeah.
And so one thing we couldn't really quantify, which I know we wanted to, is like, what is like the real true like average like net NOI like growth over a certain period of time. Like there is some CMBS data, but like it's not that great.
Yeah.
It's not that easy to aggregate. I know that's something that we're going to work on, but it's such an individual deal, sponsor, lender, market, asset.
You can kind of maybe get there if you're looking at rent growth and expense growth. Yeah. But I mean, I don't know what fees and concessions are. How that factors into either of those.
I think that there is some data out there that I think we can keep looking into. But but either way, so if you want to get the report, Matt, what's the best way?
It's greatcapitalllc.com/report.
Okay.
I'll repeat that: greatcapitalllc.com/report.
No, that's good. It's good to repeat. So so you go to the thing, and you have to give an email address.
Yes, you just fill out the form. You'll go right.
We've done the form.
So you go right to greatcapitalllc.com/report, and then you'll see the lovely title screen, and you scroll right down and fill out the report below.
Wonderful.
And that's it.
That's
It'll be in your email.
Easy enough. Okay, so let's move on to some other reports. Again, Matt, incredible job. Again, the praises that we've already received from it, and it's already gotten some media attention. Also, I've seen it pop up. I know there was a press release, but I know there were some like national outlets that have asked some questions about it. So
it's been kind of it's exciting to be kind of part of the conversation. Yeah. And I like to think we have for the past 2 years, but
maybe I guess talk a little bit about the reason why doing this report, and what gives us like the right to release a research report?
So, and this is what we were kind of talking about.
What gives you the right?
Exactly. Well, we were talking about this just before recording, and a lot of these groups, they're very reputable groups. Yeah. They're basing a lot of their data, all their hard data is like from the Census Bureau or from the Bureau of Economic Statistics.
It's all like publicly. It's all information that's out there.
Exactly.
Just raw data.
CPI or the Federal Reserve projections, and then there's also other like very publicly available rent growth information from places like Apartment List or Yardi Matrix, and but anyways, a lot of the art of these, and what makes a really great report, and I read them every week. What I like about them is the people that choose which data to follow, and this is what we try to do in this report is say these are the data. You can see publicly available a lot of data. Follow this, and this. And I think we, hopefully through that focus, we kind of communicate in a more specific way, like when this wave's going to hit.
Yeah,
and that's one of the things I think motivated us too. Is we saw a lot of stuff about loan distress.
Yeah, but it was kind of more general and broad.
Talking about the next 2 years, and we were like, well, is this specific situation? And I think that
and it could play out of where it's like, okay, maybe it is spread. There's a lot of different things and things that happen between now and then. But there are some pretty big like dates, and it makes sense from like a period, like a linear event, like something like COVID played a big part of that in pushing deals to be concentrated into a certain time period, and the way people were doing deals, and the frenzy and the growth, and then the loans that people were doing 24 months.
Yeah.
So 24 months later, now, so it's. I think part of this also, Matt, is that you were saying is when you look at these research reports every week, both of us do, but you're digging into it even more than I am. Would you call this like a researcher's research report?
Well, I don't know about like secondary or tertiary information, but we are outside of, maybe we don't pull the surveys ourselves. We're offering just the same stuff as.
But in this, there is some there is some original analysis between like equity requirements. And, there definitely is a lot of originality to this.
Yeah, I think
that's
what we're trying to add.
We're painting the picture and highlighting the data to look at.
Yeah.
And that's what we realized all these reports. There's a couple people that have their own data, like Yardi has their own data, Apartment List has their own data. But even those sources will then bring in data from outside. Yeah. Even CoStar, they have Apartment List, but they also bring in like Oxford economic data and BLS data. And so it's like if their authority is to use, they're just going directly to the source.
Yeah.
Well, we can go directly to the source also. And I think that we have a unique perspective on the market. One, we cover it every single week. We're market participants, so we do have a perspective on things. We've talked to and we're working with, and on this report work with some of the leading researchers and experts in multifamily and housing.
Yeah.
And we talk about it every week. Specifically, and the motivation to do this piece was like, we're talking about this every week, every other week. We're watching the data, we're communicating it. Like, this is, we can just keep mentioning it. But why don't we, in a sense, memorialize like what we're seeing?
Yeah.
To put it paint a complete picture. And I think we're going to continue to update it as time goes on. And I believe the idea is to continue to release additional reports as well. I think we were going to do just like a national multifamily report, but I think this was the priority. But there's a lot of good national multifamily reports out there, and maybe we're like, well, what should we do more of like on our markets? And maybe if we'll do all of it. But I think this was really, really good. Great win, I think, for the team. And I think it was healthy for the industry as well.
That's what I am particularly excited, and again, like entering into this industry, I'm very happy that so much research and data and information is available, much more than a lot of other businesses. And I think that's to everyone's benefit, and to take part in that, it's nice. It's gratifying.
It is, but you don't always know where to look for it. And that's why we're here.
That's
right.
right.
We do what we do. Matt, I want to turn to this ULI Urban Land Institute report, their spring real estate economic forecast.
Yeah.
It's talking about some slower GDP growth as inflation decreases. Always two edges of the sword. Man.
It is so crazy to think that maybe this is out of date when it's only like a month and a half old. I don't know, because things have been shaken up and down, and I don't know whether to be happy or sad.
You know what's sad? It's like, they released it May 25th.
Yeah,
that was only 2 weeks ago. But they wrote it like a month ago.
The survey that it's based on, I think, was a mid-April survey.
Oh man, it's like you might as well go back to the last ice age.
Yeah.
About,
they're forecasting. But
time flies.
I do think there are some things like that are still true. And almost maybe the bulk of it is still true. So slow growth, lower GDP numbers, lower inflation. The big question mark for me is inflation. They're expecting the year-over-year inflation numbers by the end of 2023 to be 4.1%. Right now we're at 4.9%, and we only shaved off 0.1 last month. So if we keep shaving off 0.1 till the end of the year, then we'll get right at 4.1. But 2 months ago we shaved off 0.5%. So there is, unless it's very plateauish.
Well, what I want to see, Matt, and we're going to see this in just a minute.
Mm-hmm.
I know when we look at the Yardi report and apartment list, but I want to look at rent growth. When the rent growth started to decline last year, because we know, I feel like we're a broken record, but I think it's fine. 30% of rent growth, 30% of CPI is shelter, and a big chunk of shelter is rent and real estate. And the housing market started their decline. Again, the housing segment of CPI is a lagging indicator about 12 months.
That's right.
We've learned this. We're all students of the housing economics now.
Mm-hmm.
We can go back, we can look at the data 12 months ago, and we know when the declines, and that's why everyone's like, why is housing still growing in the CPI? Why is CPI growing?
I know.
It's 12 months ago, rents were still growing.
Yeah.
Interest rates hadn't kicked in. Interest rates have kicked in, the housing market slowed down. So, are we looking at, it's going to be like all at the same time. It's going to be October, November, too late?
It could,
right around the same time.
It could be around like August or...
Okay, so 2022. So we see this. So people are like, why is inflation still high? Inflation is still high. It's like, well, yeah, because a third of it is looking back a year at this crazy rent growth it was not as crazy as 21, but very strong. Certainly, and these are compounding growth. Remember, this is growth, not just like where rents are. But this is compounding growth. Mm-hmm. It wasn't until September, Matt.
Until it started going negative. Now
it started slowing down.
Yeah, the numbers.
August will be dramatic.
It was like
slow down.
July. Yeah, from July is the peak, and then August. You're right. So maybe it's August.
So, and again, don't be surprised. Don't be surprised if we see interest rates staying high, and even another hike, before we see inflation, interest rates.
Yeah, because that it still has a psychological effect because the CPI number's high. It's still going to be. I think that it has an effect on the Federal Reserve. They can say, and I know that they know that CPI is a lagging indicator, but it makes it difficult. I think if you see a hard number for CPI. And that means everyone sees it too. So I think that there's also like kind of a political or social, but they're not political, so I don't know.
No, they could be. So anything else? So basically, Matt, you told me this Urban Land Institute report. Yes. Even though it sounds great, is it all out of date? And is that the challenge? Is that why you shared this report? Is just like the challenge of financial reporting right now? And anything is that things are moving so quickly. Yeah. That it's.
And the other one that I had to take from these notes is there's an article that talks about like, what is it, the unrecession recession or the job full recession or whatever they call it. Like there is a lot of jobs, but then these interest rates and then there's troubles elsewhere. Like it's an unclear picture. And I think the thing that is weirdest about it is everyone thought there'd be less jobs and people are still hiring.
Do you think? I know the feeling that I feel and we all feel, the frustrated feeling that I know that investors are feeling of like you want to do something, but you're not sure what to do. Yeah. You want to go out and find a deal, but there's like no deals. And so there's some FOMO, but at the same time, like things aren't like horrible.
That's
again, like I don't feel like, again,
coming
I don't
from
have
the
a bunch
recession,
of bridge loans that are coming due,
I
but
think
like
so much of, and we were talking 2-3 years ago about the pandemic and how much that shaped the market and people's perceptions, and that's when we were thinking about the Great Recession was 3 years ago. I'm still thinking about it now, post financial crisis.
Yeah.
And there was such a long time where there was no job growth, and we almost got used to this slow, but it was a slow and steady period. But I don't know, we're in such a different situation. Almost seems like a mirror of those times. You would ask someone between it for a span of 5-10 years, and people are like, oh yeah, in this economy, I can't find a job. But now it's like there are jobs. And people feel a little different. I think less dismal. There's less doom, or I don't know. They're worried about inflation maybe, but with jobs so high, it's hard to worry. Now, I wanted to pull this one up. Now, they did have a rent report, but really all we need is the map of cities that are cheaper today than 1 year ago. We mentioned their rent growth report, and it showed strong monthly growth, relatively strong monthly growth at 0.5%, still a little bit below average for the month in general. But year-over-year rent growth number was 0.9% at its lowest since 2021. Solidly below the average rate of 2.8%. And they say that it possibly could dip into negative territory in the months ahead. And the reason why I have this map up is because I think that this is highly localized. I think that the Sunbelt markets specifically, the Sunbelt markets specifically are kind of dragging the average rent growth down for the nation. You can see, as this map illustrates, the dark blue or light blue, those markets are the ones that are experiencing more negative year-over-year rent growth.
And New Orleans,
there's
down by 5.
Yeah, it's clear that it's a swath in the Sunbelt swath. Now, there are some outliers, like Miami is still strong, and Dallas, I think, everywhere in Texas is doing okay except for Austin. But it's clear. The impression is it's like the Sunbelt plus.
Yeah, Matt, look at these Sunbelt markets. I mean, Jacksonville minus 1.2, Orlando minus 1.8, Tampa negative 1.5, Louisiana negative 4.8, Atlanta negative 1.9, even Nashville negative 1.5, Memphis negative 1.8, Austin negative 2.4, Houston is positive 1.7. Yet San Antonio is positive 0.7. But then look at the Midwest. I mean, Columbus, positive 2.6. Cincinnati, positive 5.8%, really strong. Lexington, positive 1.2. Louisville, 4.7. Indy, 4.9 positive. Even St. Louis, 2%. Even Chicago, 4.5%. Yeah. So I mean, and again, like we talked about Midwest dominance. This is just more evidence for the fact that, and again, it's contra to the narrative that we've heard from so long, from so many. From, I guess, the mainstream narrative, Matt, of, the Sunbelt is the region, the best region to invest in.
Yeah.
There are great things about the Sunbelt. That certainly has the migration patterns, but it appears things are not all roses, and there are other markets that have some growth.
Yep. And it totally jives with, and one of the conclusions in the Apartment List report, now I'm kind of transitioning a little bit into the Yardi matrix because it really fleshed this out, is supply. Whether or not it has impacted, which I think it most certainly has, but it's there's a mismatch of apartment supply that aligns pretty closely with the poor performance of Sunbelt markets, suggesting that there was huge rent growth. Builders built in these Sunbelt places. Now there's more supply that's bringing it down. Now, I think another argument could be...
Man, this is a familiar market.
Yeah. So I was just also talking to Spencer. I was looking at one of the things I did in gathering my notes for this report is look at the previous months of Yardi Matrix reports, and there's a lot of pictures of Indianapolis.
A lot of pictures of Indianapolis, and I've noticed I think they've used this picture before, but they've like changed the saturation, and it's like the XDR version of it.
I don't see any. This looks like real life. If you go here, the grass is greener, the skies are bluer. And the streets are paved with gold, obviously.
Obviously, Matt. So let me find the supply piece. I mean, Indianapolis is at the top.
Yeah, I think it's page 9. Well, And let's just keep scrolling because I don't know what page it's on. Okay, yes. So
where can I find these? So Matt, like if I want these reports like mailed to me though all the time, what's the best way to figure that out?
And this is you sign up and every Thursday you'll get it if you go to graycapitalllc.com/newsletter. You will get it in your email inbox on Thursday morning every day at 8:30 EST.
How about employment and supply trends forecast rent growth?
Yeah, that's one of the ones that actually I wanted to pull out, page 9. So it was. Now, what I think is most interesting and is that some of these markets that are seeing the most completions as a percentage of total stock are the ones where they're seeing less, weaker rent growth. And Yardi says specifically for 10 of the 15 fastest growing markets, they're seeing rent decreases. Of those 10 markets that are getting decreases, 8, so more than half of the fastest growing markets of yesteryear, those metros have at least 8% or more that are going to be added to current stock. So places like Austin, Miami, Raleigh-Durham, Charlotte, Salt Lake City, Nashville, Jacksonville, and Phoenix. Now, these are the ones that you were hovering over, and we were talking about how low rent growth. And I think another important thing to note is that just because you have low completions as a percentage of total stock, that doesn't necessarily mean that your rent growth is going to be bad. I think that Miami is this powerhouse that it is because, well, you have to factor in employment too. So a place like Inland Empire, it has below average growth at 0.7% year over year, and the lowest amount of new supply coming online at 0.4% of total stock. So that's kind of the outlier because Indianapolis has the lowest amount of new supply with completions at 0.5% of total stock. And it also has the highest rent growth of these 29 markets, for really 30 if you include Inland Empire.
And it also has really good job growth, which is also on this. I mean, because it'd be one thing if it's like, well, yeah, no one's building there because there's no jobs, but the job growth, year-over-year job growth is 3.5%. I mean, even looking at...
It's definitely double of Inland Empire, which kind of explains why the difference between the two. What's also interesting, and maybe you can shed some light on this, is Las Vegas is weird because it's got great job growth. It's got an average amount of new apartments being built, not 0.5, but 1.7. It's not like it's 5%. Anyways, there are only 2 months out of the past year where Las Vegas had above average month-over-month rent growth. In that same period, and I was talking to you about this before, Indianapolis was above the average for maybe all but 1 month. And it's really the story of Indianapolis. And I know that we talk about this because it is the home of Gray Capital, but it is a story of steadiness. Maybe there's only like 1 or 2 times when it was the top of monthly, but it was just sticking in there in the top. Yeah. It was steady and it didn't go high and then go low. And there may be a little bit of a rubber band effect in some of these markets.
I felt, for the longest time, I feel like, Indianapolis wasn't getting the credit it deserves. And it still probably isn't, but I do, I feel like I want to be aware of not to take like too big of like a victory lap on the Indianapolis is doing great. Because it has now been in the headlines so much, and now it's like right now I have to start knocking on wood because there are cycles. But the fact is, I mean, Indy has stuck around. Yeah. And has been, when things are great, it's still doing pretty well. Mm-hmm. When things are bad, it still is doing really well. And it's really well when everything falls off, it's all of a sudden at the top of the list.
And I think a lot of it is affordability. That's another thing that the Yardi Matrix covers is the rent to income ratio. And Indianapolis is at, number 2 for most affordable. Now New York, for reasons of its own, it is both the most expensive and the second highest for year-over-year rent growth. But that whole group of affordable markets like Kansas City, Indianapolis, Austin again, not, but Miami, Boston, San Jose, all of those are among the top top markets for year-over-year rent growth.
Yeah.
Or at least positive and healthy. Like, it's a good rule of thumb. Obviously, these are all factors. Like, you look at the rent to income, you look at the job growth, you look at the supply, and you might be able to get to a good place. But man, it's a pretty good yardstick, especially if there is going to be a ceiling that renters are able to pay. That was in this Wall Street Journal article. It was like, well, maybe they're just done with paying. Well, the most affordable markets would be more resilient, I think, in those circumstances.
Yeah, and again, future economic uncertainty, if we do see the unemployment rate go up, it's going to be those markets that can absorb those hits.
Yeah.
And people are going to be moving into because all of a sudden they're out of a job and like, where can I go that's like affordable? I can't afford to live in this high price market anymore.
Yeah.
So it's fascinating. Matt, we didn't get to some of the pieces, Fannie Mae, Bloomberg, Wall Street Journal. You mentioned the Wall Street Journal piece. We can probably talk about it on next episode. But again, greatreport.com, greatcapitalllc.com/report, just to get these things just sent into the inbox.
Oh yeah, you need
every
it
week.
Yeah,
every single week. And leave us a comment. We meant to get the comments today.
Oh man, we do not have enough time.
We don't have enough time.
Maybe we'll do a short. We can do a short video later.
Let's do it. Maybe we'll do like a follow up. We'll do like we're on a roll because we've got the report that's come out. We've got all kinds. We have the report. We did the YouTube live yesterday. We've got the full regular Great Report episode today. Then we're gonna have to do an appendix.
Yeah.
We've got an event this Thursday. By the time this comes out, it'll probably already be happening. But we've got a fun event downtown Indianapolis. So we're gonna be doing more of those. So I guess get into our ecosystem, sign up for the report. You'll probably know about it in the future. Appreciate you taking the time to watch the report. We'll catch you next week on the Great Report. Make sure you like this video. Make sure you're subscribed. Leave a comment below. We'll get to it next. We're going through comments next video, so leave them to us. All right. See you guys.